If you can still remember, I told you in the previous episode that the management, as the preparer of the financial statements, asserts this one, that the FS that they made is correct, it's fairly presented in accordance with the accounting standards, and that there are no material misstatements in the financial statements. I also told you that if you are the auditor, your job is to test their assertions, right? So in today's video, we are going to answer the main question: why do we need to test the financial statement assertions of the management? But aside from answering that, this video also aims to give you a clear understanding of what is a financial statement audit. And now, let's start. Again, why do we need to test the management's FS assertion? Direct answer: to gather sufficient appropriate evidence to support an opinion. So this answer is very short, but we need to break this down. First off, what is this sufficient appropriate evidence mean? Actually, sufficiency refers to the right amount of quantity of evidence, while appropriateness talks about the quality of audit evidence. In short, sufficient appropriate evidence is an evidence with the appropriate quality and quantity. And since we're talking about evidence already, let me give you the rules on the reliability of evidence. So there are four. Number one, evidence is more reliable if obtained directly rather than indirectly. So example of which is the evidence extracted by the auditor, for example, based on his or her own observation, is much more reliable compared to those evidences extracted by indirect means. Example of these indirect means are those evidences obtained through inquiry. So let's go to number two. Evidence coming from an environment with strong internal control is more reliable than evidence extracted from an environment with weak internal control. So if you wanted to understand this in simple terms, I have here an example. So information coming from a department with a well-established system of recording and processing of transactions are more reliable than information obtained from a department with no proper process or system of recording. So the third and fourth are self-explanatory. So number three, written evidence is more reliable compared to oral evidence. So that's self-explanatory. And number four, evidence in the form of original documents are more reliable compared to photocopied ones or facsimiles. So that's it for theories related to evidence, the meaning of sufficient appropriate evidence, and the rules on the level of reliability of evidence. Next, let's talk about opinion, specifically the FS audit opinion. As a breakdown of this answer again, since we have already talked about the evidence, now let's discuss about opinion. So what is an audit opinion? An audit opinion is a statement by an auditor about whether the financial statements being audited is free from material misstatements or fairly presented in accordance with the accounting standards. Actually, it's the primary responsibility of an auditor to give such opinion. So that's an audit opinion. There are types of opinion that an auditor can issue. We have number one, the unmodified opinion. So this is an opinion given by the auditor stating that the financial statements are fairly stated in accordance with the accounting standards, based on the audit evidence gathered, of course. And we have number two, which is the opposite of the unmodified opinion. That is what do we call the adverse opinion. The auditor's opinion here is that the financial statements are not fairly stated in accordance with the accounting standards. Example, there might be a recording of a certain transaction which violates the accounting standards. It can also be said that adverse opinion is an opinion of the auditor stating that the financial statements are materially misstated, and that particular misstatement is also pervasive. I know that this is very technical. So to understand, let's define material misstatement. So a misstatement is considered material if its presence or absence changes the decisions of the users of information. Meaning, if there is a misstatement and its presence or absence does not really change or affect the business decisions of the users, then it is considered immaterial. But how about pervasive? The misstatement is considered as pervasive if it overshadows the true meaning of the financial statements. For example, I have this actual experience with a client who instructed me not to include depreciation expense in the income statement because they are losing. And if that depreciation is eliminated, the company will register a big profit instead of a loss. Naturally, I declined and explained the effects of non-inclusion of depreciation expense. So let's say for example, I agreed and the depreciation expense is eliminated. That is considered not just a material misstatement but a pervasive one also. Because that misstatement will give an appearance that the company is profitable when in fact it is not. So that's the meaning of pervasive or pervasive. Another type of opinion is what do we call the disclaimer of opinion, which is actually not an opinion at all. The disclaimer of opinion only states that the auditor can't give any opinion on the financial statements because he or she did not obtain sufficient appropriate evidence to support any type of opinion. This is usually due to a scope limitation or limitations. So what is a scope limitation? Scope limitation means that important audit procedures were not done by the auditor. Again, if you are the auditor and you have not done some audit procedures, the technical term for that is scope limitation. Now, in order for the auditor to issue a disclaimer of opinion, the scope limitation or the unperformed procedure or procedures must be material and pervasive in nature. So disclaimer and adverse opinion is very similar to each other in terms of that. But remember, they're not the same, okay? In adverse opinion, there is really an evidence that management did not follow the accounting standards. That is what do we call departure from the accounting standards. In disclaimer of opinion, there is no sufficient appropriate evidence gathered to support any type of opinion. I hope that's clear. Now, before we end this type of opinion, please take note that the scope limitation can be because of the management. Like for example, the management is not cooperating with you as the auditor in the performance of your job. That's what do we call management or client imposed scope limitation. A scope limitation can also occur due to circumstances not necessarily within the control of anyone. Like the auditor haven't observed the ending inventory count last December 31, 20x1 because he or she was only engaged as an auditor on February 14, 20x2. So that's a scope limitation due to circumstances. And that's it for disclaimer of opinion. Lastly, we have qualified opinion. A qualified opinion is expressed by an auditor in two instances. One, if there is a material misstatement, but the misstatement is not pervasive. Again, not pervasive. And number two, if there is a material scope limitation, but that scope limitation is not pervasive. Again, not pervasive. So the clue terms here are material misstatement or material scope limitation but not pervasive. So that's it for the types of opinion. Again, why do we test the assertions of the management? Answer: to gather sufficient appropriate evidence to support an opinion. Next is we will have to appreciate the financial statement audit by answering three additional questions. So stay tuned. So a while ago, we have answered the question, why do we need to test the assertions of the management? And over the course of answering that, we answered two sub-questions, which are, what is the sufficient appropriate evidence? And what is an audit opinion? So at this point, we will answer the third question for this video to appreciate the financial audit engagement more. And the third question is, what assurance does an audit or examination provide? Answer: an audit in general. So we're not just talking about the financial statement audit, but other types of audit as well. So again, an audit in general provides reasonable assurance. Again, reasonable assurance through an opinion stating if the subject matter conforms with the established criteria. So if this is a financial statement audit, the FS auditor provides reasonable assurance through an opinion stating if the financial statements are conforming with the applicable accounting standards. But if you will be asked, what is the type of assurance the audit or examination provides? The answer is positive assurance. And if you will be asked about the level of assurance the audit provides, you can say high level of assurance. So that's it. However, before we end this slide, I would like to emphasize that reasonable or positive and high level of assurance is not the same with absolute assurance. An auditor cannot ever give an absolute assurance. Why is it? Because of a lot of reasons, and one of it is judgment of the auditor is not perfect. As a human, the auditor is prone to error in judgments. Another reason is that most of the time, auditors test only a few of the transactions or only test a sample of the transactions for efficiency. So, audit procedures usually cannot be applied to all or 100% transactions because again, it will be inefficient. For example, if you are the auditor performing inspection of documents, you are not expected to inspect all the documents for one whole year. You just need to select samples from the 100% population. Another reason is fatigue and stress. So, those are some of the reasons why the auditors or practitioners cannot give absolute assurance. Now, let's end this slide by giving you the biggest misconception about the financial statement audit. And that is the thinking of the public or users or clients that if the company is audited, then it follows that it will become successful in its operations. It is not. Auditing only results to giving an opinion if the subject matter conforms with the criteria, and it does not provide assurance at all that the company will become prosperous. And that's it for the third question. We are now in the fourth question, which is the second to the last question that we are going to answer in this episode. And the question is, why is it that financial statement audit by a CPA is necessary or demanded by the public? As of now, I know you can already devise your own answer, which may or may not be similar to this. So, financial statement audit by a CPA for me is really necessary so that the users of information can have reasonable assurance through an opinion of the practitioner stating if the financial statements are fairly stated or not. Because again, they have to make business decisions based on the FS information. So, it's as simple as that. But did you know that you can actually break this simple answer down? Let's do that. Actually, you can say that financial statement audit by a CPA is demanded due to the following. So we have a mnemonic here, the CVO-CF. C stands for conflict of interest between the users and the management slash employees. So what do I mean? Example, investors as primary users of FS information wants the company to succeed and wants the correct financial statement information to guide them in their decision making. While management slash employee sometimes just wants to earn salaries even without working hard, and sometimes they don't really care if the company that they're working for is in good condition or not. Sometimes they also don't care if the FS information is correct or not. Another reason Why FS audit by a CPA is needed? It's because of the expertise of the CPA. No one is more knowledgeable or capable enough to check or audit the financial statements aside from CPAs with meaningful experience. The next reason for FS audit is the voluminous transactions. Financial statements can sometimes be misstated due to large number of transactions being processed by the audited company. Another reason is users are far from the day-to-day operations of the business. And because of that, users most of the time actually don't have any idea how the company is doing. Another reason for FS audit is complex transactions. Again, financial statements can be misstated due to the complexity of transactions being processed by the audited company. And lastly, we have the financial consequences. Users must make sure that their business decisions are correct. But imagine if the FS information that they're relying to is actually materially misstated. If that happens, they are sure to make the wrong decisions, which will usually lead to financial consequences. And that's it. The last question is coming right next. So we are to answer the fifth and the last question. But before we do that, I am really assuming that you are already painting a clear picture of what is a financial statement audit engagement. The question is this the end for the financial statement audit? Unfortunately, no. This is just the beginning and an overview of the FS audit. Actually, the question number 5 will help you complete the overview on FS audit. And the question number 5 is, what is the step-by-step process of a financial statement audit engagement? Before we start, I will emphasize that each of the stages that will be mentioned are lengthy topics and should be discussed in a lot of separate videos in the future. But today, I'm just going to give you a little bit of description of each stage. So the first stage is the pre-engagement activities. So in any engagement, meaning not only in the performance of financial statement audit engagement, CPAs should not readily accept engagement with clients. He or she should perform pre-engagement activities. Why? To ensure that he or she has enough resources to undertake the engagement and to make sure that the prospective client has integrity or honesty. And if there are no problems while performing the pre-engagement activities, you can now move to the next step, which is the acceptance of the engagement by drafting an engagement letter. Terms and conditions of an engagement must be in writing to avoid conflicts and misunderstandings between the practitioner and the client. And after accepting, audit planning follows. So before the actual evidence gathering, planning must be done in order to devote the time and resources to appropriate areas of the audit. The goal of audit planning is to make the audit efficient as well as effective. And normally, after audit planning, the auditor designs his own audit program, which contains the specific audit procedures to be performed. So, after the audit planning, the next stage is the actual evidence gathering. So, using the information gathered by the auditor in the audit planning stage, the auditor will now perform the audit procedures and audit program that he or she designed to obtain sufficient appropriate evidence which will become the basis of his or her opinion. And this is followed by completing the audit stage. In this stage, the auditor performs wrap-up procedures and makes the final checking if there are still FS information that needs to be investigated further. And lastly, we have the preparation and issuance of report, containing of course the opinion of the auditor. So those are the stages of the financial statement audit. Again, each of these stages are lengthy topics and should be tackled in different future episodes, but it will only happen after the overview of assurance and non-assurance engagements, which we are still on. So in the next episode, we're going to talk about audits in general. as well as the review engagement and other assurance engagements. So see you on the next episode.